But nonetheless, let's get going. Okay. So everyone should be able to see my screen. They should be able to see TradingView with total 3 and USDT dominance with the chat on the right-hand side. At the bottom, you can see that today's trades, they are 0 and currently not in any positions. So that is that. Vicky's been through this, so it sounds good. Yeah, perfect. We're going to cover it. Kind of show you guys like the roots of how you can go about this and how to actually take on some things. I'm going to go to the S&P 500 just because that is my note. That's what I used to create notes. Just give me 2 seconds. I'm just going to mute. I need to sneeze. Okay. So, topic of discussion, how to deal with losses. Right. Someone's mic is on. Just going to server mute Brendan for a second here. Let's get back. How to deal with losses. Okay, so let's bring this up to 40. And let's actually just do that as well. So everyone can see. Okay, cool. This is the topic of discussion. Make it a line, make it 2 pixels, how to deal with losses. Okay. So starting off, right? Someone give me an account size, just any account size. Someone in chat, just give me any account size of any number that we can use as an example.
5,000.
5,000. Let's do 5,000. Okay. None of this is subjective to the amount. It's just subjective to the percentages. So if you're working with 5,000, if you're working with 100, if you're working with 10, it'll all be the same. But let's say we have a $5,000 account, right? This is our account size. Don't worry too much about the number. Just worry about what the information that I'm about to give you. Okay. So starting off with a $5,000 account, let's take it from step 1. Okay. What is the step 1 once you load in $5,000 into your account or whatever starting balance you have, right? Step 1, okay, is to work out obviously risk management. Okay. For this example, I say this all the time, but we're going to go over this again. Sorry, that's very wrong. 0.5 to 1% risk management, right? Now, here's the thing. We always say 0.5 to 1% risk management, but the thing is when you first load in your balance, right? When you first start with $5,000, you do not want to be risking 0.5 to 1%. You want to be risking a quarter of your maximum. Okay, so if your maximum is 1%, if your maximum is 10%, if your maximum is 20%, risk a quarter of that. So in this example here, we're going to risk 0.25%, right? Why do we do that? It's so that we can minimize the drawdown on the account until we get this number up. Okay, so specifically on people's psychology and their mentality, if you start off with 5,000 and you risk 1%, right? And you risk 1% of 5,000 and you lose that trade, you're already in drawdown. So mentally, it's going to be quite tricky to bring that out of drawdown because you're going to be like, oh, should I just load it in 5,000? I'm about to get messed up. My account's down already. My account's already in drawdown. Mentally, it's a bit trickier to manage an account that's already in drawdown versus an account that's in profit already. Just because if you have profits, like even if you get the account up to 5,025, right? You now have $25 in profit. So you have this mentality that, okay, I've already made $25 on this account. If I lose $10, it's not going to make a difference because I'm already up. I'm still up on the account, right? So that's why I'm telling you guys now, if you load in an account or if you're at a point where you take a break from trading or you just don't feel confident or you're on a losing streak, start risking with 0.25 just so that you can get some profits on the account, right? Just so that this account can get up to, because like, look, let's think about it. You take one trade, right? You take one trade that is a 1 to 4 risk reward ratio, right? And that is already going to be 1%. So you've already made 1% on this account just by taking a trade that is a 1 to 4 risk to reward ratio, which isn't that difficult, right? So the first thing we're going to say over here is how to deal with losses. We're going to move over this way. We're going to say here, 1. Start with quarter risk until you make profits on the account. Okay, let's make this a little bit smaller, make it 24. There you go. So there you go. Number 1, start off with a quarter risk until you make profits on the account. right? A quarter risk of whatever it is, right? It could be 10%. You could be risking 2.5 or whatever your a quarter of whatever you're risking is. It's important to understand that you just need to just drop it a little bit just until you can get some profits on the account. Just win one trade. Literally just win one trade, and then you can play around with the risk. Okay, that's the first thing that we need to understand, right? The second thing we need to understand is that every trader, no matter how skilled or how long you've been in the market, you will have a negative month. Okay, if that negative month is a losing streak, if that negative month is just you taking one trade and leaving it and then just ending it up in a negative month because the market didn't give you a setup, if it's you just taking bad positions or listening, trying a new strategy or whatnot, you will have a negative month every single year of your trading, right? But the problem comes in when people take this negative month and they let it snowball, right? What I mean by that is that if you lose 2 trades in a row and you're down, say, 2% on your account, right? How do you get to the position where you are actually, how do I say, not getting mentally torn out about this kind of situation, right? So the first thing you have to do, next step, is to set a limit to how much you can trade. Okay, so this is what I do personally: set a trading limit. Okay, that's number 2. This could mean that you take one trade a session. When I say session, I mean like London session, New York session, Asian session. You could take one trade per session. Okay. What that does for you is that it basically tells your mind that I can only take one trade, therefore this trade needs to be a good trade. So automatically you're then looking for setups that need to be a good setup. Okay. I don't follow this one trade a session rule, but that's what I know some people do, and it does work for them, and I understand why it works for them. Trading limit could be only one trade per pair. Okay, so if you trade Bitcoin today and you lose that trade, you can't trade that again for the rest of the day. If you take a trade on Euro USD, you cannot trade that again for the rest of the day if you lose the trade or if you win. It just allows you to not get back into the market after you just lost the trade. So, for example, my rule that I run is that if I take a loss, I can't instantly get back in. Okay, so if I take a trade on Euro USD for a short and I get stopped out or not liquidated, if the position gets liquidated and I get stopped out, then I can't enter that immediately. I can't enter the same trade again, right? Even if it goes in my direction, I cannot get back into that trade, right? Because I already just lost on that trade. My setup was wrong. I need to then look and see, instead of saying, oh no, the market's moving in my direction, I need to go back and see, why was my setup wrong, but the market moved in my direction? What could I have done better? Was there a fib that I missed? Was there a zone that I missed? Was I on the wrong time frame? Did I not look at the correlation, or did I not look at this or that? Like, it's just important to understand that even if the market moves in your direction, you're not sitting there going, damn, I missed the move. You're sitting there, instead, you're just sitting there going, what did I do wrong? How did I not miss that zone that was above my stop loss? You know? So that's number 2, right? Set a trading limit. Number 3, we move on to something a bit different. But number 3, we're going to use, let me just make sure I word this right, is increase and decrease risk according to account. That's not the right spelling of decrease. Increase or decrease risk according to account, right? So what does that mean? So I'm going to break it down for you real quick. If you have a $5,000 account, every time, let me change this number to a smaller number real quick, just because people putting in money into their own accounts won't really put in $5,000. Let's change it to 100. Let's say you put $100 into a crypto or Forex account, right? And you are risking, let's say 5%. 5% is decent risk. I know people that risk more. Actually, quickly, in the chat, let me know, how much do you guys risk per trade? If it's more than like 10% or if it's like 15%, don't feel ashamed. Just let me know how much you risk, because obviously it goes according to your own plan. Just give me a quick one. How much do you guys risk per trade? 1 to 3%. 3%. 3%. Why 3%? Like what makes you risk 3? That's such an odd number. Lily says 1%. 5 to 10 on $200 account. Yeah, ego. I'm more on ego's vibe. I'd risk about more like 5 to 10%, yeah. 0.5 to 1%, 5%. Yeah. Just the initial thing I've learned was starting with 3 to 5%. Small account, so enough that the reward feels worth it. If I lose 2 trades and drop 2%, then 1. Oh, okay, cool. I see you. Makes sense. Okay. So let's just say you have a $100 account, right? And you're risking 5% per trade. Let's actually make it, yeah, let's make it 5% per trade, and your half risk is 2.5% per trade on a crypto account. Let's just say that's the number you're busy risking. When do you compound up, right? So the main thing to do, like I've done a class on this a while ago, but increase and decrease your risk according to account. Whenever you double your account, $200, get this account up to $200, you're then going to risk the same percentage, but of $200, right? So let me say that again. 5% of $100 means you're risking $5, right? You're risking $5 on this $100 account per trade. You're going to keep risking $5 until this account gets to, whoops, let me do this right, until this account gets to 200. Okay. Once your account gets to $200, you then readjust and you now risk 2.5 to 5% of 200. So now you're risking $10, right? Then the thing that happens here is once you double this again, right? So you get to 400, then you risk 5% of 400, right? So every time your account doubles, you keep risking. So 400, then it goes to 800, then it goes to 1,600, then 2,400, etc., etc. But every time you double it is when you're going to need to adjust your risk again, right? Because the percentage gain is still the same. You're still making 100% on the account every time you're doubling your risk. Even though the money gets bigger, the percentage gain and the percentage risk stays the same. That's why when we came in at the beginning of the course, I started telling you guys, stop reading your accounts in money. Read your accounts in percentages because it makes more sense, right? Because if you read your account in a percent, you can actually manage and you can actually hold on and you can actually read things a lot better. And you can actually not get caught up in this thing of like, I just lost $50. But it's actually like I just lost 1% on my $5,000 account. You know what I mean? So looking at it at a different perspective, you can actually get around your mentality a bit better, right? So for example, MetaTrader, the guys that trade Forex on MetaTrader allows you to view your profits in like currency or in points, right? I know a lot of people that actually changed their MetaTrader to view money or view positions in points. So instead of saying negative $50, it'll say negative 10 points. I don't know the exact amount that the points will be referred to. I don't do it, but I know some people do it. But instead of saying plus $100, it'll say plus 100 points or plus 50 points or plus 20 points, depending on the currency you're busy trading and the market that you're trading. The points will vary. Like, for example, gold will trade at a different point reading at what the currency indexes will. The NASDAQ will trade at a different point reading than what gold will trade at. Like, for example, metals trade at different points than what the Forex exchange trades at, and indices trade at different points to what metals and the indices trade at. So when you're working with points, you don't actually know how much money you have. You just know that you're in profit by X amount of points, right? So it helps them say, like, for example, if the account's up $50, they won't go, let me take profits. They can actually stick to the plan, right? Because a lot of the times people lose trades or they lose their accounts because they don't stick to the plan, right? So, this coffee's good. Because they don't stick to the plan. right? So for example, let me use another example here. That brings on to my next point, right? Is everyone catching along? Is everyone following along? Everyone happy with what I'm saying? Everyone have any questions? Let me stop there first. Let me check the chat here. Makes sense. Igor is typing. We wait for him to type. Let's see. How to make a trade rules if you are beginner, you don't have experience. Okay, we can go over that. After I do stick to the plan, then we can go over it. Okay. So basically, stick to the plan, right? What does that mean? What does that essentially mean? It essentially means that if your account was at $100 and your account gets to 200, right? Your account's now doubled to $200. Now, all of a sudden, you lose a couple trades, you had a bad week or whatnot, and your account gets back down to 120, right? Sticking to the plan just means that you can't get back into the market, or you can't just keep re-entering into positions so that you want to make your money back, right? You need to understand that you took some losses. You need to understand that maybe your setups weren't that great. You need to understand maybe you made a mistake or you had a losing streak, right? But sticking to the plan, it means you got to wait, right? Wait for that setup. Like when I do my live sessions for London trading, a lot of the times I just sit here and wait. Or other times I just sit here and look at the market, wait for the setup to play into my hands, right? I don't force any position. Some of the times I'll take one trade a day, not even. Some of the times I won't even trade on a day. Like on a news day, I won't even take a trade, right? Or I'll wait for the news to cool off before looking for a position. I don't get eager to get into the market. You got to stick to the plan. If your trading plan is like a 1 to 3 risk to reward plan, and you're trading trend lines, and all of a sudden you take a trade that is nowhere near a trend line, right? Let's say this is your let's say this is your trend line over here, and the market's sitting here, and all of a sudden the market's like here, and you decide, see, I want to go short till the trend line and then long. But this wasn't part of the plan, right? This over here, this short down to the trend line wasn't part of the plan. Because you got impatient, you forced a trade. So you took this trade here, you tried to go short in the market over there. It's the wrong side of the position, let's get a short. You tried to go short over there to go short down to here just for a 1-to-1 because you were like, I haven't taken a trade in the past week. I want to go short. Then all of a sudden the market takes you and then reverses up and takes your stop loss. And now all of a sudden, shit, I lost that position. Now you want to get back into the market because you think, it's going to bounce there again because that's the area that where we broke structure, and then boom, it comes back to the trend line, stops you out again. Right, so now you're in this situation in your head where you're not even following the strategy because you just wanted to make some money that day. Right, you got to stick to the own plan that you have set up. Okay, so let's go over what a plan looks like. Okay, I'm just going to go to I think I put it in the mindset section. No, it wasn't. It was an educational section of the Discord. Where was this? I think it was the book section. Yeah. $50 a day trading plan. Okay. Let me switch out that project output. Okay, cool. You guys should be able to see Discord now. There we go. So let's go over this $50 a day trading plan. So this diagram is built around a 5K account. You can adjust risk accordingly, but the idea still stands. Okay. So this can be found in the book section of the Discord. It's free to everyone. So you guys can just go grab it there. Okay. Risk management. Okay. Risk between 0.5 to 1% per trade based on a $5,000 account, right? This is based on a $5,000 account. So risk is 0.5 to 1% per trade. Okay. 1. Target a 1 to 5R trades. 2. Right. So minimum 1R, maximum 5R trades. 3. The time frame you take the trade is the same time frame you will manage the trade. So if you take the trade on the 1 hour, you're going to manage the trade on the 1 hour. If you take the trade on the 1 minute, you're going to manage that trade on the 1 minute, which means, what does that mean? Essentially, it means if you are on the 5-minute time frame, right, and you're looking for a demand zone, and an area taps the demand zone, price taps the demand zone, and then you go to the 1 minute to enter on that position, right? It could be that you're looking for a demand zone on the 1 hour, and then you go to the 15 minute to enter, or you could be looking for a demand zone on the 4 hour, and you go to the 1 hour to enter, right? Take into perspective that the demand zone's on the 4 hour, but you're entering on the 1 hour, or the demand zone's on the 5 minute and you're entering on the 1 minute. Okay? When you take that trade and you enter on the 1 minute, that is the time frame you need to watch when you want to make decisions on whether or not you need to close, take profits, or move stop loss to break even. Okay. After I've said that, that is the most important thing that you need to understand. You can't take a trade on the 1 minute. You can, but look, this rule you can break, but you need to understand the rule first before you can understand when to break it, right? Like for example, I was talking to, I think it was Renando. It was yesterday or 2 days ago. I was talking to Renando, and he was like, "Yeah, no, I took a position. It was against my rules, but the position went in my direction." And then I was like, you see, that's a perfect example of you understanding your rules and understanding it to the point where you know what you need to do and what you don't need to do. And when a setup comes along where you're like, see, this setup could work, but it's against my rules, he lowered his risk, first of all, and then he entered the trade, right? So you need to understand the rules. You need to be able to work the rules before you can start breaking the rules. Okay. Next thing. Okay, let me just actually, never mind. I hope those notifications don't come up in the recording. Getting like WhatsApp notifications on my desktop. But essentially, the time frame you take the trade on is the same time frame you'll manage the trade. So for example, you take a trade on the 1 minute. When you break structure on the 1 minute, you move stop loss to break even. When you break a high on the 1 minute again, you would take profits like that, right? You can't go to the 5 minute and then manage the trade, right? You got to stick to the 1 minute just until you start understanding how to trade, right? For example. So move stop loss to break even after we break the most recent high or low, or create a break of structure, right? So for the guys that don't know what a break of structure is, it's essentially when the market continues to make lows or continues to make highs in a already trending market, right? So if the market's moving up and it breaks another high, it's a break of structure. Or if the market's moving down and it breaks another low, it's a break of structure because the market's continuing the trend in the direction that it was going in, right? As soon as you break a high or low, you move stop loss to break even, right? Why do we do this? Or why do you see me moving stop loss to break even very quickly when I'm trading? It's because if we come back to tag my stop loss, I can enter again, right? Just because I got stopped out at break even doesn't mean the trade's done. I can look for another entry because I never lost anything on that position, right? So there you go. So daily overall risk is no more than 3%, right? So essentially how this works over here, it says risk management between 0.5 to 1%. If you're risking 1% and you take 3 trades and you lose 3%, you cannot trade anymore on that day, right? Versus, so for example, if you're risking 1% per trade, you can take 3 trades. If you're risking 0.5% per trade, you can take 6 trades before you basically lose that 3%. Okay? So you just need to work out what you want to do. So for example, how this is worked out is that we take the maximum risk and we times it by 3 to get the daily overall risk. So if you risk 10% per trade, then I would make it 30%. The 30% maximum daily risk. And that is a lot. I would even make it like 20% or 15%. And then, yeah. So like, for example, what I do in this situation is I risk 1% on a trade. If I lose that trade, I'm already down 1% on the account. Then instantly after that, for the rest of the day, I will only be risking 0.5%. Doesn't matter how confident I am on a setup, doesn't matter how the setup looks in my eyes. If I lose one trade and I'm already down 1%, I'll instantly half my risk and I'll start risking 0.5%. Right? If I win my first trade and I'm on 1% and I gain a position, then I can risk 1% again. Okay, hope that makes sense. Let me just check chat real quick. Are you guys happy? Are you guys happy? We see your mouse. You have 2 mouse cursors. Yeah, my bad. That is a problem. It's just the way the recording's busy. It's like set up. Let me actually click this down here. Whoops, didn't mean to click that. I want to click this. Okay, cool, yeah. Everyone happy? Everyone good? Yeah, okay, cool. Good, okay, cool. As long as everyone understands. If you don't understand, just stop me. Okay. Next up, trade rules. Okay, so that was risk management. Trade rules. You should buy or sell when the market says, not when you need to make profit or fear to make a loss. Okay, that's the most important thing you need to understand in trading, is that you don't just get into a position because you want to make money or because you're already losing for the day. You get into a position when the market gives you the opportunity to get into a position. That's mental. That's all mental. Like, chances are, like, if I upload this recording, it'll get half as many views as any video I'll record with a strategy. Because everyone's keen on learning a strategy. Everyone's keen on learning how do you trade, like what's the best risk to reward strategy, what's the highest win rate strategy. Everyone cares about that, but no one gives a shit about your mentality. No one cares about the mental, but it's the most important thing you need when trading. Right? So if you can get this into your head, write it down and stick it next to your computer. Stick it next to your laptop. Write it down on your desktop. Doesn't matter where you have it. Make it your wallpaper. But you need to understand that you should buy or sell when the market says, not when you need to make a profit or fear to make a loss. That is from Richard Wyckoff, right? The exact quote reads, if I can remember it, it reads, the tape reader takes something like the tape reader takes positions when the market offers, not when he fears to make a loss or wants to make a profit, something like that. Next one, trade rules. Wait for an impulsive wave. Look for supply and demand levels and imbalances. Right. This part's very important here. Wait for an impulsive wave. Right. If the market is busy consolidating, there is no impulsive wave. Right. Normally, you'll see supply and demand levels pick up after you see an expansion. Right. So you just got to wait for that expansion. Like, chances are, if you're on the 1 minute and you're trading the 1 minute and trying to scalp it, right? You can either take 5 scalps and make 5%, right? Or you can just wait for that impulsive move. If it takes 3 hours, you just wait for that impulsive move, wait for a supply and demand level or an imbalance, take a trade off of that, and then you ride it for 1 to 5 hour, and you'll make the same amount of money in the same day, right? Like, you can either scalp the market and you can take 10 positions a day, or you can just trade supply and demand on a higher level or a higher time frame, and then just essentially take 1 trade a day and make the same amount of money. It's up to you, right? Number 3, wait for price to come back to your zones. Important. Once you've identified the supply and demand levels or imbalances, wait for price to get to your zones before taking a trade. Don't chase a trade. If you miss it, get the next one. Important. Very important. And yeah, wait for 3 confirmations. 3 confirmations could be supply level, Fibonacci, and break a structure or change a character. Like, supply level, Fibonacci, change a character. There's your 3 confirmations. Or you can use volume, point of control. Actually, no, not volume and point of control. You can use point of control, supply level, or demand level, and you can use candle structure. That's 3 confirmations. As long as you have 3 confirmations, you can take the trade. Do not take the trade if you do not have 3 confirmations, right? Then at the bottom here, it says trade symbols. Stick to 3 to 5 symbols and focus on them, right? That's important to understand. Okay, I'm just going to switch you guys back over to TradingView, and then we can carry on with the rest of my rant, basically. Just give me 2 seconds. Just trying to flip it over, clicking on all the wrong things. There we go. Where is TradingView? There it is. Cool. You guys should be able to see TradingView right now. Let me just double check it. Yes, sir. Got TradingView and the chat on the right hand side. What is Skinny saying? Probably biggest lesson I've learned so far, and why I'm focusing on this part this year. Strategy doesn't mean anything if the mentality isn't there 100%. That is facts. We all have one. Wait, what? Well, have a good one. I got a shower. Okay, cheers, brother. Cheers. Enjoy. True. I think it comes down with experience. Yeah, literally. So For example, stick to the plan. That's important. Okay. The next thing that I want to say that goes in with increase and decrease your risk according to the account, it's knowing when to decrease your risk, right? So now we know that when you double the account, so if you get this to $200, that's when you can increase your risk, right? When do you decrease your risk? Okay. You decrease your risk when you drop 50% off of the original balance. Okay. So what does that mean? We now know that if we make 100% on $100, we get to $200, right? What is 50% of $100? It's $50, right? If your new balance drops 50% of the old balance, you de-risk on the account. Okay, so let me break that down a little bit simpler. So you have $100 and you're risking 5% per trade. I think we said 5%. Yeah, we did say 5% per trade. You're risking 5% per trade. You get 100% on the account. Now all of a sudden you have $200. If that account drops to 150, right, which is 50% of the original balance, right, then you de-risk. And how do you de-risk? You risk half. Okay, so instead of risking 5% of $200, you're now risking 2.5% of $200. Okay, yes, you're going to make money slower, but you're also going to protect your account from losing more money. Okay, so now you're on 2.5% and you are on 150. If that account goes up to, now that account gets back up to 200, you can then start risking 5% again. Or actually, no, make it higher than 200, make it like 220, right? Then all of a sudden, now your account gets back up to 220. Cool, you're now risking 5% again. Oops, 5%. Again, now all of a sudden, you're like, cool, you go back on a winning streak. Now you get up to $400, right? Which is double the next balance, right? So it's double 200. Okay. Now you get up to $400. Okay. Now you're sitting there and you now risk 5% of 400. Okay. What is 50% of 200? Someone in chat, I'm going to keep you guys awake. What's 50% of 200? Someone? 100. There we go. Thank you. So you got 100, right? If this account drops $100, which is going to take you down to 300, you halving your risk again, 2.5. And that's going to protect your account from losing any more, and etc., etc., etc. If you get to $800, what's for 50% of 400? It's 200. And then once $800 drops to 600, you risk 2.5% again, like blah, blah, blah. That's how it kind of works. That's how the risk management pattern comes along. So you got to understand when to risk more and when to risk less. Let me delete all of this. And that's basically the understanding of how to deal with losses. The one thing I do want to share with you guys is something that I had to overcome. Basically, it was the beginning of January. Yeah, it was January. I was in a losing streak on my account. I lost about 8 trades in a row. What ended up happening was it started on one day where I lost 1 trade. Next day, I lost 2 trades. So I was 3 losses in a row. Then the following day, I took 1 trade again. That's 4 losses. Then I took a break until the end of the week. So I didn't trade for the rest of that week. So I was on 4 losses. That following week, I took a trade on the Tuesday, took a loss. Then I took another trade later that day, took another loss. And that's it. That's 6. Waited 2 days again because there was news or something like that. There was like a lot of news in January. So I waited like 2 days, took another trade and took a loss. Basically, I lost 8 trades in a row. Right? My account was down. How much was it? It was down about 8%. Because all of those trades were 1% risk. Because I basically took a trade on the days where I took 2 trades. I was trading in the London session and I risked 1% and I lost. And then the evening or like the afternoon, I was trading New York session. And because it was a separate session, I risked 1% again. So I took that as a loss as well. So I was down about 8% on the account. And essentially, what happened was once I got to the point where I was down 8% and I lost 8 in a row over like 2 weeks, it was about, it was about maybe 2.5 weeks. I got to a point where I was like, you know what? I'm doing something wrong. Like, I can't be losing 8 in a row, right? So essentially what happened was I went back. So I went back to all the videos that I watched, the course that Lorenzo put out. I rewatched that entire course. Went to a couple of my friends that are traders that are making fucking bank trading. Someone I know in another Discord took a position that was like $43,000. Fucking ridiculous. So I went to them and I was like, "Yo, dudes, can you guys give me some advice? I'm on a losing streak." And they basically just told me to just go back to demo and stick to the plan, because I thought I was doing something wrong in my trading strategy. That's why I went back into the notes and like back into learning the strategy again, because I really thought that I was missing something, and I was. But the thing that they told me was, dude, you're down 8% on the account. If you don't want to lose more, go to demo, right? Open up a demo account and trade for the next week. Whatever strategy you trade for the next week or 2 weeks or 3 weeks only on that demo account until you can become profitable on the demo account, and then learn what you were doing wrong. And then you can then come back to your account and start trading your account again. So I was like, you know what? Let me try and do that. So essentially what happened was, at the end of the day, I was feeling like shit mentally because I lost 8%, and now I have to stop trading. I can't make any more money. I need to go back to a demo and rework the strategy, understand what I was doing wrong, try and relearn the market, right? Because I picked up a couple of things that I was basically doing wrong, and I kept making the same mistake, and I couldn't see that I was making that mistake. Then I went back to demo it took about 2 weeks on demo, trading every day, just taking positions, understanding the market, became profitable on the demo account, then went back into my account and then started trading my account again, and essentially brought that account back up to break even after the loss, and then I started making money on that account again. So that's essentially the key to dealing with losses is all mentality. It's all knowing when to stop, all knowing when to kind of give up and then take a break. What was the mistake? I was reading the market's time frames wrong. Okay, so for example, I can actually show you exactly what I was doing wrong. Let me go to like gold or something. Let me go to gold. Okay, so what I was, oh, that's a messy chart. Let me go to something else. Let me go to like natural gas or something. Okay, can't go to natural gas. Go to Euro USD. Okay, here we go. Let's get a chart that's like not full of nonsense. Okay, so what I was essentially doing was I would start on the daily time frame, and I would kind of look like, oh, we're trending down and we're retracing to the upside. Then I'd go, okay, cool. We're looking for longs, right? Go to the 4 hour, and I would say, okay, cool. The area of demand that we bounced off of was here on the 4 hour, so we can still move up to the upside. Then I go to the 1 hour, and I'd say, okay, cool. Where are we right now? Then what I would do is I would ignore the consolidation, right? So I would ignore that this entire area here is just consolidation, right? And I would go in and I would go deeper, and I would find a reason to go long or to go short. Like over here, right? I would find a reason that like that's liquidity. Liquidity down, that's my OB. It's my supply zone, my point of interest. And then I would say, okay, cool, if the market gets here, I'm going to short it down to take out these lows over here. And this would be my setup, right? And I would wait for that setup. Market would literally then trend in, tap me in, trend, and then take me out, right? And the problem, wait, let me actually say, what is the problem that this is? Like, where's the problem here? Do you guys understand what the problem here is? Because that'll be a really great lesson. Try to figure it out. I'll give you guys just like a few minutes just to try and figure out what the problem with shorting there is. Or, well, for you, you might want to take that position, but I see a problem with shorting that. You need to know what zone the market is in. Okay. Not quite. Trading a trending strategy is a consolidation zone. Trading a trending strategy, no, that's not the problem with this 5 minutes. Just a setup. I'm thinking there's no direction in that move. I don't know, liquidity on top and on bottom. Yeah, there's kind of equal highs, I guess. Something somewhat over there. Okay, I'm gonna give you the answer. So for me personally, I wouldn't take this because there was a breaker structure here. Actually, it's breaker structure down. Sorry, change of character down. My bad. Change of character down, and then immediately break structure up. And that is a sign of market moving upwards, right? So first of all, we had the change of character to the downside, then we broke structure to the upside, and we never came down to take out any of these lows, right? So there is no confirmation that this market will move down, right? In the setup right here, I just found something that looks like an order block, and then I figured that this was a change of character over here. So I figured this would be a change of character over there. Chalk, if I go to the 1 minute, I would probably be able to justify that this is a change of character. And then I would say market's coming up and I can sell down, right? So the thing with this setup is that, yes, it could play out. Yes, I could wait for the 5 minute to get into this zone, wait for a 1 minute change of character and then sell. But the problem is that, hold on. The problem is that this is just consolidation. This is consolidation, right? So I'm trying to trade nothing. What am I trading? There's no trend, right? Personally, for me, I don't see this as a worthy setup, right? So this is just a consolidation. Yes, you could come down, but yes, you could also just go up, right? So what would I do in the situation? I would identify this nowadays as consolidation, and I would say this is my demand zone at the bottom. So I'd wait for the market to expand outside of this consolidation to the bottom, then enter here to go up, right? Instead of looking for a position that doesn't exist. Okay, this position, it becomes tricky. Like smart money concepts becomes tricky. This position does in fact exist. This is a position that will make sense to some people because you're targeting liquidity. You're targeting for the market to move this in the opposite direction. You're targeting saying this change of character was on the 5 minute, and then you had rejection of a double top on the 5 minute again, then came down. Like you can justify it for yourself, right? But for me personally, I wouldn't, because you're trading nothing. For me, I like to wait for setups that play perfectly into my hands, and that would be us coming down to here and then moving up, right? Or what you could do here if you wanted to take this trade is match it with the dollar. Well, can the dollar bounce here? No, it can't, right? It's also consolidating. Like you're in this position where you're just consolidating on the dollar, right? And you have this area at the bottom here where you're constantly bouncing in. So it looks like the market might want to go take out these lows and come deeper into this zone. And if that happens, this will completely go up, right? This will go up to that zone there, take out these highs, right? Then you'll get that expansion, that breaker structure there. So that's the difference, right? It's understanding zones. It's understanding price action. The market has a reason to come down here. Like the dollar has a reason to come down because it can take out this resting liquidity, right? And the same way that euro, oops, wrong chart. The same way that euro USD over here can go up to take out that resting liquidity and that resting liquidity over there, right? So you can see that there's also this liquidity here, right? So the market has a reason to go up, right? Market has a reason to continue moving. Whoops. This needs to be the dollar. Yeah. The market has a reason to continue going up. So therefore, I will stay out of this position. Right? For me personally, my selling zone for euro is up top here. So my current situation for the Euro USD on the 1 hour, I'm looking to take out the liquidity at the top. Because look, once we go up to this level, we're going to be tapping into a nice 1 hour area of supply that we can then reject off of to take out all of this liquidity at the bottom. Right, so you've got liquidity top and bottom. Market moves up to there, we come down to here. That's my setup that I'm looking for. Kind of write it down like this. Okay? So you just got to understand, like, you got to find the way that you can trade SMC in your way. Actually, I want to see, just watch how this just pushes straight through the zone now. Because the dollar can still come down into this zone here. And Euro's already in that zone over there. So you're going to have to wait for dollar to come all the way into here, and then you can only go short. And chances are, if it comes all the way down into this zone here, this is going to break. Right? And then if it breaks, it's going to come down. You could catch it over here. But then the problem is that you have this liquidity line that's going to get extended. Okay. Market always has a reason to go somewhere. It never just goes somewhere like for no reason. It'll always have a reason to go somewhere.